in a time of chaos, the commodity trading houses are there to deliver the right stuff at the right time to the right place. That was a theme that came through a lot of conversations. This is an industry that's built to be resilient, even in times of chaos. And it was quite interesting to get a look under the hood, so to speak, at how different firms are doing that.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter markets are here.
Welcome to Scenes from the FT Commodities Global Summit, a special episode of Smarter Markets. I'm Dave Greeley, Chief Economist at Abax Technologies. Smarter Markets was back at the annual Financial Times Commodities Global Summit in Lausanne, Switzerland this March, where commodity traders get together to talk about the markets and how they are navigating them. In retrospect, this year was the calm before the storm of the wide-ranging U.S. tariffs imposed by President Donald Trump. We partnered with the FT to once again interview commodities markets participants to ask them about the big developments being discussed at the conference this year. We also discussed the ways that markets and market infrastructure need to change to keep pace with the changing commodities trading landscape and what tools and technologies they need most. We've compiled a selection of those 5 interviews into this special episode of Smarter Markets, with a special introduction by Leslie Hook, Natural Resources Editor for the Financial Times. If you would like to listen to the full interviews, they're available on our website at smartermarkets.media on the Smarter Markets Presents media page. They're also available on our second podcast channel, Smarter Markets Presents, available on all major podcast platforms. Our guests in order of appearance in this episode are Leslie Hook, Natural Resources Editor at the FT; Halima Croft, Managing Director and Global Head of Commodity Strategy, RBC Capital Markets; Mark Kristoff, CEO at Traxys; Fernanda Avila, Congresswoman and former Secretary of Mining, Ministry of Economy in Argentina; JP Albin, co-CEO of BGC Group; and Sasha Lifshitz, Head of Battery Materials at Abax Exchange. We hope you enjoy these scenes from the FT Commodities Global Summit in Lausanne 2025. And I'm pleased to be joined by Leslie Hook, the Natural Resources Editor at the Financial Times. This is great because we're able to record this introduction after the conference when we both had a little bit of a chance to take a step back. And Leslie's kind enough to once again join us to give us a little bit of an introduction to the conversations that you're going to hear next. And Leslie, I think the Global Commodity Summit that the FT hosts every year is one of my favorite conferences of the year. You get all the right people in a beautiful location. And to me, it feels like more of a get-together than a conference sometimes. Obviously, there are hard-hitting panels, but it's also a chance to get the industry together to really talk about the issues that matter. And it's always an interesting agenda. It's always an interesting time in the markets when you host this conference. I don't know how you get the timing right every year. This year was right before the tariffs from President Trump went into effect. But I wanted to ask you, as you were putting the agenda together this year, were there certain topics you wanted to make sure got discussed at Lausanne?
Well, putting the agenda together is always a little bit of a looking into a crystal ball type exercise, but there were some clear themes that really came out of the conference this year, and one was just uncertainty. Nobody knows what Trump is going to do next. What is his next tweet going to be? What's the next executive order? And there was certainly a mood of uncertainty at the conference, which was held in late March. And even now, Dave, as you and I are sitting here today and having this conversation, we've had the Liberation Day tariffs, we've had the global stock meltdown. There is just huge policy uncertainty. And it feels like in a time of chaos, the commodity trading houses are there to deliver the right stuff at the right time to the right place. So that was a theme that came through a lot of conversations. This is an industry that's built to be resilient, even in times of chaos. And it was quite interesting to get a look under the hood, so to speak, at how different firms are doing that.
And it's been such a topic of conversation in recent years, the focus on supply chains that, I feel like pre-COVID, most people wouldn't give them a second thought. Obviously, these folks, supply chains are what they do every day. What was your takeaway from how people are thinking about managing the risk in those supply chains? And, I think as one of your panelists said, the trading house is acting as a shock absorber for the world economy.
Yes, I think that was Richard Holtum of Trafigura, actually, that used the shock absorber phase. I think managing risk is hard. But one change, I think a lot of the measures that were put in place around the time of the energy crisis and the Russian invasion of Ukraine, when we saw these huge sudden changes in markets, I think a lot of those measures are still in place and are helping to meet margin calls and just provide the sort of cushioning. I mean, one thing that's really striking when you look at the large trading houses is that they have a lot of cash on hand, and they've also built up their own group equity. After these years of super profits, they're now in quite good financial shape. And one thing that came up a few times is how some of the trading houses themselves have kind of become lenders. They've become financiers of projects, whether that's through prepayments or another structure, but they're starting to take on a little bit of a different role in the supply chain and also move into different parts of the supply chain. We see quite a few trading houses getting more involved in upstream, whether that's buying more gas power plants, more refineries, but reinvesting some of their profits from those really good years into physical assets.
And now, as you look back at the conference, were there any moments or topics that may have been surprising, or ones that were prescient, or ones that just you took away as the ones that stick with you?
Well, there were a few themes at the conference that we haven't touched on yet that I think are really going to carry forward into the next couple years. One is metals and the way that traders that might have their roots in oil and gas are moving into metals, expanding into metals. Obviously, it's a very different market than energy, but there's been a lot of investment in that space. And I think that's going to continue. And I'm really interested to see where that's going to end up when we have this conference again this time next year. And another is the questions about the energy transition. Is the pace of the energy transition proving to be kind of different than what was expected and different than what energy economists forecast? I think that particularly given the current US focus on bringing back more coal, oil, and gas, it does really call into question some of the forecasts that were made around the energy transition. And I'm really interested to see where that trend goes this year.
And before I let you go, Leslie, is it going to be 15 years next year for the FT? So I know you just a lot of work pulling off the conference every year and you just wrapped it up, but I'm curious, what are you looking forward to for next year for the 15th?
Oh gosh, Dave, I haven't really started the planning yet for next year, but I do think by this time next year, we'll have more of a sense of where these tariffs have ended up. And we'll know whether it was all a ploy to get better deals and then we're going to go back to the quote unquote before times or not. So it's going to be a really interesting time.
Halima Croft, Global Head of Commodity Strategy and Middle East North Africa Research, RBC Capital Markets. Where do we start? I think one of the big question marks of this entire conference has been, what does President Trump want when it comes to energy? And I think that's an interesting conversation to have because on the campaign trail, he talked about $50 oil, unleashing American production. Can you unleash American production at $50? And then he talks about potentially really taking a tough line on American adversaries. So we've had the return of maximum pressure. We've had new sanctions on Iran announced last week on teapot refiners. While we've been here, we've had the new concept of a secondary tariff. Usually we talk about secondary sanctions when we sit down together, but Now we have secondary tariffs on Venezuela, basically 25% tariffs on Venezuelan imports into key markets like China and India. So much to discuss, like how does he get all of his competing objectives realized, or does something have to give?
And I think that's the question everyone's trying to get to is, what does he want? I think people are searching, is this some sort of a policy? Is it some sort of like objective in mind? But where do you think the president's coming from?
The interesting question is like, what is his most important priority? And so when we think about, tariffs, one of the things that's been so interesting versus Trump 1 and certainly previous administrations is his willingness to use tariffs to affect non-industrial, non-economic policy change. It's Venezuela tariffs, the secondary tariffs. If you look at his Truth Social post yesterday, it was basically about, narco traffickers, and it was about migration. And then he brought up elections. And essentially you're looking at this as like, okay, we're going to impose these secondary tariffs. But, to what end are we achieving this in terms of getting a major behavior change in terms of Venezuela policy on migration? Are they supposed to have free and fair elections now? Like, it's interesting to take a step back and saying, like, what's his top objective? But what I do think is interesting is if we go forward in terms of, let's talk about the next couple of weeks, we're going to have a real interesting question about like, how serious is he going to be about enforcing these tariffs and the new sanctions on Iran? Because that could be potentially material for oil markets. Like if we really did start, trying to interdict ships, if we really tried to start squeezing Chinese refiners, ports that take Iranian barrels, like are we going to go after potentially Malaysia because where some of the barrels are washed? Like there is a scope for, several 100,000, maybe 500, 750,000 of Iranian exports to come off the market. Like what does that do to price and what's the backfill? Does he hope that Saudi Arabia will just rush to his aid like they did in 2018? Remember, we exited the Iranian nuclear agreement. We told the Saudis we were taking Iran to zero. That fateful OPEC meeting, June 2018, where basically they pushed through a 1 million barrel a day increase. And then we gave exemptions at the beginning of November and the prices tanked. So I don't think that OPEC in Saudi is particularly eager to backfill a coercive American policy against one of their members, even a member they've had difficult relations with. I question again, like if we were to see like the full enforcement power of the United States brought to bear on Iran, like how's that going to square with his desire for lower oil prices?
Thinking back to other conferences, other years, kind of a common refrain has always been, well, we just want certainty from policymakers. That's often what you hear the business side say. Now we're in an environment where anything could happen.
Yeah. President Trump, I think, prides himself on being disruptive. I mean, This is a much more disruptive first couple months in office than we saw with Trump 1. And so I think it's very hard for market participants to sort of gauge where we're going next. And again, I think about, tariff policy, the fact that he's prepared to use tariffs as de facto sanctions, I think makes it harder to figure out like what the end point is. Like if we think about, Canada tariffs, I mean, they're being deployed for a variety of reasons, including, fentanyl, including we want Canada to meet their NATO defense spending obligation.
And what would your advice be? There's lots of traders in the conference, lots of people trying to manage risk in these markets in a period where there's so much uncertainty and the end game is so unclear. What's your advice?
Well, what I think I would say when I tell clients is to think about who are the key influencers when it comes to President Trump. And I think we can go down the wrong path if we think it's people just like us who are basically the most important voice in the room. And so I think there's a lot of emphasis on what is Scott Bessent thinking, the Treasury Secretary thinking, what is the Commerce Secretary thinking. And I say it's important to know what Stephen Miller is thinking, because Stephen Miller, the Deputy White House Chief of Staff, I mean, he has such an outsized role in setting the policy agenda for President Trump. I mean, he was even on that, Signalgate conversation. He seems to be in every important room. And he was with President Trump in the first administration. He stuck by his side during his 4 years out of office. And so I think it's important to also think about like, what is the worldview of Stephen Miller and how does he shape the conversation for President Trump?
Mark Kristof, Chief Executive Officer of Traxxas globally. Well, I think the common theme is the reverse globalization trend, the trade wars, the geopolitical uncertainty is still really dominating most of the discussions. It's clearly creating confusion in the marketplace. But, we view that as opportunities to solve problems for our suppliers and our customers. And that thematic seems pretty clear. I think another theme is that the commodity trading businesses have done pretty well in terms of profitability over the last couple of years. That money is being reinvested in expansion of the businesses, asset purchases to support the flows and the continuity. The banks are here looking for new business from the right counterparties. So we're seeing a strong support of liquidity for the market, which is critical. But in general, I think it's reasonably upbeat with the overlay of kind of geopolitical uncertainty.
I wanted to ask you about that first theme, the kind of the reverse globalization. How is that affecting Traxys, or what challenges and opportunities does it create?
Yeah, listen, as I said, I've been in the business for 42 years. When I started, our business was exporting from China, who was the raw material supplier to the world. You also had the disgorgement of the strategic stockpiles in the Soviet Union and the United States and some of the Western nations. So there was surplus material, product prices were kept low for a long period of time. You didn't have new CapEx coming in as a backdrop. You had China Inc. expanding steel production from 30 million tons in the mid-'80s to 1 billion tons today. So you had a massive shift. For the first 35 years of my business career, it was a globalization trend. Supply was ubiquitous. Supply chain got very efficient. Our job was to get product next to our customers for just-in-time delivery. And they outsourced purchasing capabilities to us and the industry at large. Obviously, COVID happened. Big wake-up call for supply chain and how interlinked it is. And then you had the backdrop that started under Trump 1.0, where trade tensions accelerated, and you saw some real disruptions and dislocations in supply chain. We're seeing that now. I think that affords companies that are thoughtful in bringing supply solutions to their customers to develop kind of regional supply capabilities, solutions, trade block friendly solutions that kind of address the very heavy duty regime that we're seeing for certain products and certain traditional flows.
I wanted to ask you, given your 42 years experience, because we've seen such a change in China, right? You mentioned years ago they were the raw material supplier. Now we're seeing China increasingly dominant kind of across the battery supply chain, from the critical metals to the batteries and the electric vehicles themselves. How are you thinking about that change and how non-China companies need to be engaging with China now as opposed to 20, 30 years ago?
Yeah, the Chinese have done a very effective job of controlling and taking dominant positions in products. We saw this in tungsten in the late 80s and 90s, where they really built a capacity that put Western productions underwater. They then did move to rare earths in the 90s. We identified that as a trend, and that's why we bought Molycorp in 2008 from Chevron to provide a Western rare earth alternative. The Chinese very judiciously managed price, as they often do, and made Western production not competitive for a period of time. So when you have a competitive landscape of really very coordinated, thoughtful approaches to strong market positions, if not dominance, that can move profitability throughout the entire supply chain, competing with Western capital, which requires a discipline of, at a minimum, 90-day earning cycles, you have a very significant challenge to create that alternative supply capability.
And when you talk with, your clients, your partners in markets, and they're looking at this environment, what do you think they need in terms of tools, in terms of products, in terms of way to navigate where we're at?
I think this is underpinning price volatility and uncertainty. So when you think about products like new exchanges, like ABAX as an example, the CME is expanding their activities. I think the LME is tried, but but has not been successful. But I think the ability to have price discovery, transparency, and additional tools to manage that price risk, either as a producer that wants certainty around what the sales price of their product is, or the consumer or user of the product that wants to have visibility of what their raw material cost is going to be for a period of time. So I think, this geopolitical uncertainty, the volatility in pricing is all driving a need for more tools to manage that risk.
I'm Fernanda Avila. I'm Congresswoman for the government of Argentina and the former Secretary of Mines from Argentina.
Well, we just got to be on a panel together, and I found your perspective really engaging as someone in a large producing country, so important to future production of copper and lithium. And I just was curious for your perspective when you look out on the world and the developments in those markets from Argentina. How do you see the world right now?
I think that, as you said, David, we were in the panel together, and what we've heard these days is a lot of geopolitics. But that's the key word that we've been hearing. And mining is talking about that, because this thing between China and the United States is really shaping the way mining is developing. And it's the same thing in Argentina. Argentina's position is particular because we've had a lot of economical instability in the last couple of years, as you all know. So the first thing that we had to do was try to make things better in the economic side for the investments to come. That's why we launched this regime that gives stability for 30 years, a range of stability for 30 years, and legal certainty to investors and other things that make the investment to go forward. So I think that's key for us as a country in Argentina, of course. And we're welcoming all investments from all over the world. But other thing that's very important in this rush that we have to develop mining for the energy transition and for the security that the governments need is having these key conversations with different government or countries. For example, we signed an MOU this year with India to develop our mining industry and critical minerals and transfer of technology. We also signed last year an agreement with the European Union in the same sense. So those are the things that we're trying to do, having bilateral conversation with governments and also fostering investment with specific measures from the government.
And as many of the early conversations on the panels this morning were about energy transition, a word you just used. And I'm curious, from your perspective, do you see it slowing down, picking up, or changing?
I think that maybe I would use the word changing. I don't know if it's slowing down. Maybe it was a rush at the beginning, and now the words are changing. We've spoken a lot about energy transition and just transition, and now everyone's talking about security, but the investments are going further. So I don't know if it's so important for us as a country which words they are using. The important thing is that we keep going further. I do think that talking about energy transition make a change in the way people see mining industry. We've seen that a lot in Argentina since we started talking about lithium. That's something that we've talked a lot about last years. And the people from Argentina especially, that we are not such a mining country. We've had our tradition in mining, but we are now going more aggressively into that industry. I've seen how the mindset have changed, and they see people in Argentina see mining as something that's necessary for this energy transition and friendly. And when you talk about security, that's not something that compels us as Argentinians. So I think the word shift, it's not so good for the industry. I don't know. We can see it in the future, but the important thing is our investment going further. Well, I see that they are. In fact, as I mentioned, this regime that we launched, we also saw the impact in terms of exploration budgets. Globally, the exploration budgets were stable in 1.8%. The growth was 1.8%. But in Argentina, the growth was 95% last year. So the fact that the exploration budgets are going so high, it sends a message about maybe this regime that we're doing is appealing, but also that the mining industry is still going further to develop the potential.
JP Aubin. I'm the co-CEO of the BGC Group.
So I know you've got a lot going on at BGC Group right now. I was wondering if you could just tell us a little bit of what you're focused on.
Sure. So we are an American company. Today, our revenue is $2.5 billion with a market cap of $4.7 billion on NASDAQ. We are growing, by the way, and that's why we're very happy to be in Lausanne today in that summit. We're growing on energy, commodities, and shipping division. We do expect, by the way, to close the acquisition of OTC Global Holding by the end of Q1, so in a few days. If we do, and that's our expectation, we're going to be the number one broker in the world, leading broker on ECS, with close to $1 billion revenue. And that's why we have a lot of clients and partners here today.
Congratulations. And for some of our audience who might not understand, how do you describe the role of brokers in the energy, commodity, shipping space?
Well, more and more, we do realize our clients need data. That's where BGC, we're pretty good today, but we can do more, obviously, producing data for our clients. They're definitely buyers. And when we will have that strong and big division of ECS, close to $1 billion revenue, we'll be able to not only monetize data, but provide our clients with exactly what they do expect from us. So not only being the intermediary between the buyer and the seller, but also providing the data they need. So that's our mission.
And you told me this was your first time at the FT Commodities Summit. What brought you here this year?
Our size. Okay, we do believe in number one, critical size, then market share. Then when we have both, we can expand. That's where we are today for the very first time on ECS, because at the beginning, BGC is a fixed income company. But we're now becoming very strong on ECS, energy, commodities, and shipping. And that's why I thought for the very first time, we have to be here because we're strong now. And I came with a lot of my partners from Houston, Texas, or London. And we are really impressed by the quality of the summit.
And what made ECS such an attractive area to move into at BGC?
You know, our main friend is volatility because we're brokers. We don't have positions. We found there's a lot of underlyings within the ECS division, and could be metals, could be soft, obviously oil, natural gas. There's a lot of things, and it's part of the day-to-day life of every human being on the planet. So we needed to be there, and we decided to invest, and that's why the acquisition, our expectation to close OTC Global Holding will bring us definitely what we need.
I'm curious, with it being your first time at Lausanne, is there any particular panels or topics of conversation that you found really engaging or stimulating?
I have to say the power of gas, natural gas, compared to oil, the new source of power as well. That's super interesting. That's what's going to be the world tomorrow. And we follow the trend with passion. And we think everything I heard, again, spoke about quality people. All the leaders of the industry are here in Lausanne. It's like the kind of the Davos of commodities, right? Which works.
My name is Sascha Lifshitz. I'm head of battery materials at Abax Exchange.
I hear lots of conversations around lithium. Are you hearing the same?
You know, it's talk of the town, hopefully. We've launched our contract 2.5 weeks ago, and people know that it's out there, and we're drumming up the interest to get people trading the contract, and yeah, it's going well so far.
I mean, one of the nice things about the FT conference here in Lausanne is that you get a lot of folks from the trading community, the merchant trading community. Just curious, what are you hearing? What's when you talk with people about lithium, nickel sulfate, where's the state of the conversation in the market?
Look, I mean, it's quite a depressed market. I think that doesn't come to anybody's surprise. And the market sentiment, and maybe that's also one of the reasons why not too many people are here compared with last year's on the metal side. So it's a bit of a downbeat market, but I think, the trading will always happen, sometimes a bit more short, sometimes a bit more longs. But the interest is clearly there. And as we are creating a contract that doesn't exist and will also help the industry to find better, smarter price points for the product, it's good. I mean, just one of the discussions I've had today with one of the lithium projects, which are actually only in the financing phase right now and going to start producing in a few years' time. They're very interested in that because they clearly see the value of launching such a contract and having tools on hand for risk management, longer dated forward curves and price fixing. And when the market is in the state like it is today, very depressed, there's even more interest from the community, to price risk manage those products.
And one of the areas that hasn't been as depressed is copper. People seem quite bullish on that. But also, when you look around the world, regional spreads are much bigger than they've been. Obviously, tariffs, potential tariffs. How are you sizing up, what you're seeing in the copper market and the role of tariffs? How are they affecting battery materials?
Look, I think they're already affecting on the copper spread. I think that's the most prominent you see in the current market. Copper spread has gone from $400 to $1,400 basically in a month, maybe a few weeks more. And that's going to persist now. And it's going to be interesting to see how these tariffs actually, start in the beginning of April. And volatility is clearly there. I think, one of the reasons is also why we're looking at copper now more in detail and try to come up with a copper spread contract. I think the first initial discussions we've had with the industry is everybody says it sounds quite interesting. Obviously, they need to see the details. But so far, on nickel sulfate or lithium carbonate, we haven't even seen the effect of that yet. And if you consider that the majority of those products currently really stays in the Asian region, we're not going to see the full effect yet. But once you start building a supply chain, maybe also in Europe, in the United States, and then those intermediate products flow into those markets, I'm sure, you will also see those price differences on the back of tariffs reflected in the prices of the underlying product. So again, here, I think we're well positioned with having our regional contracts to take advantage of that and help the industry, to manage this risk as well.
And before I let you go, I know you've spent a good portion of your career as a metals trader, a nickel trader in particular. If you look out at the market with all the uncertainty, all the volatility, any advice you'd have for people who are in those seats now?
Listen, I hope, that people still know how to manage risk. I mean, at the end of the day, the way we've learned, or I've learned, part of my business is really political risk. And that's exactly what we have nowadays, with all these tariffs and the different trade blocs and political camps. And I think that's really something people have to understand. It's not just, the volatility is nice and everybody, I think at least the trading community cheers volatility. But to understand really, and the medium longer term, to try to understand those political risks and what implication it has on prices, on regional imbalances, and how they can take advantage of that, that's absolutely key. And I think a lot of the younger people maybe have not seen, these vicious moves. I think here again, maturity and people who have been in the industry for a long time maybe have a little bit of an advantage. So sometimes I think, it would be nice to be back. But then what we're doing is equally important and exciting.
Thanks again to all of our guests and to the FT for partnering with us at their Commodities Global Summit 2025 in Lausanne, Switzerland. We hope you enjoyed this episode. If you would like to listen to the full interviews, they are available on our website, smartermarkets.media, on the Smarter Markets Presents media page. They're also available on our second podcast channel, Smarter Markets Presents, available on all major podcast platforms. We'll be back next Saturday morning, returning to our podcast series, Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.